Stocks have been resilient despite war and oil concerns and questions over AI exuberance. Growth stocks, especially technology and speculative stocks, surged. 401k plan participation nationally is growing, and savings rates are too. Economic signals like inflation and GDP are mixed. The new Fed chairman may influence the economy. We'll cover that and more today in this quarter's Quarterly Context presentation. I'm Greg Patterson, CEO of the Advisory Group, and these webinars are designed for clients and friends of the Advisory Group to help provide context and perspective. For those of you not familiar with the Advisory Group, we are a wealth and life strategy firm focusing on business owners and leaders and their financial goals in their personal and financial family realms, their fiduciary employee support efforts with retirement plans, and their communities through foundations and endowments that they have either founded or are involved with. To complement that strategic goal work we do with clients, our Quarterly Context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns, as well as other topics to help all of our clients stay more relaxed by being more informed and making better decisions focused on what matters most. We'll cover a number of topics as usual, and as always, we like to remind people to focus on that space between things that matter and things that you can control. You can't control the economy, you can't control how you respond to markets and the economy with a disciplined strategy to help increase the chance of long-term success. Our clients always come first. Our business model is fee-only objective, and we're one of the first firms in the industry decades ago to accept fiduciary status in writing. Our goal is to help our clients achieve their goals and live better lives and have bigger and better impacts on people that they care about and the organizations that they are involved with. In terms of the economy and markets, rates held steady during the change of the helm of the Federal Reserve to new Chairman Warsh, remained between around 3.5% after a bunch of cuts after a series of hikes in the last few years. And new Chairman Warsh has signaled that he will aggressively fight inflation with higher rates and rate hikes if necessary. And inflation, as shown here, has pushed up a bit due to a number of factors. Overall rate was 4.2 for the quarter, but cooled a little bit in the third month of last quarter in June, down to closer to 3.6 annualized. So we'll see what happens in terms of those pressures with the dynamics in the Middle East and oil supply questions and concerns being a big factor in terms of what's pushing up inflation currently. Despite some of those concerns, the stock market was surprisingly strong, primarily due to excitement around technology, continued excitement around AI, and there are also, and despite questions around to what degree that excitement is justified or sustainable, something that only time can tell. That 15% of the broad US large cap market was also beat by the small cap market at almost 22%, and growth stocks in particular within large cap were closer to 17%. Unemployment cooled a little bit, but that's a bit of a false drop because labor participation rates were down, so unemployment really hasn't changed very much functionally. And GDP numbers looking a little more solid with at 2.1%, and some revised numbers recently adjusting for periods, for example, where this 0.7% was during the government shutdown a few quarters back. And some temporary variables like that can cause GDP numbers to bounce up or down a little bit more than would be normal long-term numbers. As mentioned, stocks were quite strong for the quarter. The NASDAQ had the best quarter in the last 6 years. Technology was up 32%. And interestingly, last quarter we were talking about gold having very strong returns, but now is negative for this last quarter. And we mentioned that gold can be volatile and can spike in both directions. And that's what's happened this quarter. Last year it was up by, I think it was 40+%, and this quarter it was actually negative. Inflation pressures are happening, as mentioned, due to the oil in particular. There's also been cooling in the labor market and uneven economic growth. The Fed is paying close attention to that, trying to navigate that and steer the economy as smoothly as possible. And with that inflation dynamics, let's talk about a Fed rate increase, projected one before the end of the year, that would bring it closer to 3.8%. And interestingly, the new chairman declined to give his estimate of how many rates there would be or what the rate hike would be. Has a different approach to public communication, but other Fed regional representatives have continued to give their estimates so that the market has some information to work with. Labor did cool a bit below the expectations in the last quarter, based on the most current numbers available in May. And in terms of a few unusual dynamics, SpaceX had their IPO in June, which peaked, the share price shot up a bit, peaked at $2.6 trillion just 3 days later, but then lost $1 trillion in the days leading up to just this week, and is now below the original offering price. We mentioned this because this was an enormous IPO, and index companies are making special exceptions in some cases because of its size to incorporate it into the index. That's been a challenge for index companies who have rules about when things are added and how long they wait before something is added to an index. But this level of size is causing them to rethink some of those things. And as you may recall from past quarterly context discussions, the S&P 500 already has had about 38 to 40% in the top 7 stocks. And this will further expand that concentration in the S&P. So that makes for an interesting dynamic, more concentrated, with something like SpaceX being even more speculative than the existing companies who have been said to have stretched valuations, although some would argue that the valuations are fair, given the opportunity and seemingly infinite scale of some of those companies. So intelligent people will disagree on those topics sometimes, and the market will have its own opinion, up or down, over time. And there is more talk on that note around irrational exuberance, going back to Chairman Greenspan's comment of a few decades ago before the dot-com crash. Not that we're expecting a dot-com crash, because the companies that are so large now, or even larger than, with high PEs, have earnings, have solid business models, unlike a lot of the companies in the dot-com boom. But it doesn't mean that there can't be some excessive excitement and momentum and exuberance around those stocks, and that means it's prudent to be cognizant of that and not be overexcited and expect that the markets can be bumpy when there have been such strong excitement around a small number of stocks. Overall, for the quarter, there are always bits and pieces of news. A lot of it has to do with oil and the Iran war, inflation jumping as a result. That also hurt bonds, because when inflation goes up, that makes expected impact on rates and bonds, can cause some bond return drops, and all of that added up. Despite those questions, the excitement around some of the stocks in AI and overall economic situation, despite some of those concerns as well, still ended up positive, quite positive for the quarter. Here we can see some of those numbers. The US up about 15, international up about 10, emerging up 24, emerging stocks. Real estate in the US up 11, or global real estate rather, and the bond market a little more tepid because of some of these rate and inflation questions. while the global bond market was a little bit stronger. So I'll remind everyone that 10-year expected average annualized returns are closer to 7.5%. So these single quarter returns double, triple, and quadruple that in some cases, nearly. And whenever markets are that strong, even if markets were a little cooler last quarter, it's important to be aware that that can precede some volatility. As we mentioned last quarter as well, this is the first time, last quarter was the first quarter in a while where the 5-year bond number was not negative. It's positive again this quarter, despite some of the bond concerns related to inflation dynamics. But after that rate hike period a few years ago, that damages bond returns because it pushes up the rates on new bonds, which makes existing bonds seem less attractive and can cause negative bond returns. So that depressed bond returns and held them in negative territory for a while, but now the 5-year numbers are positive, and you'll see that numbers start to creep up as much like the 1-year numbers are as those numbers normalize. If we look at different slices of the market and different time frames, we can see even if large cap and technology and growth were very strong for the quarter, as mentioned just a moment ago, just even looking at year to date, we can see large cap growth, despite the 10-year numbers still being very strong, and some would say a little overly strong. The year to date numbers are still weak because of the first quarter. Second quarter offset that, bringing them back up to those numbers we talked about. But overall, you can see here is a bit of a reversal, a bit of a mirror image where the smaller the stocks and the more value the stocks, the lower the returns were in the last 10 years, but that is reversing year to date and may be part of a adjustment trend that would be normal over time since markets are cyclical. The market patterns, if we look at the 4 worst markets in history, and their subsequent recoveries, you can see a lot of bumps here. Took whether it was the Great Depression or the dot-com crash or the oil and economic crises of the 70s. This current market and following that has had COVID and other dynamics, and still a faster rise because of a lot of the excitement around AI and other dynamics, especially driven by those relatively small number of stocks. Valuations cooled a little bit last quarter, remained around the same level after the second quarter, but still at the upper end of the normal range of valuations, which would suggest that overall the market is a little bit overvalued. And oftentimes when that's the case, there's some cooling on the horizon. No one knows when, next quarter, next year, but don't be surprised when markets normalize. That's just a regular part of investing in economic and investment cycles. If we look at value versus growth, we can see the long-term average of the PE difference between value and growth. Value stocks have been making a comeback, and now it's just approaching a more normal level of value and growth discounts. That doesn't mean PE growth and value will be the same. It just means that the normal differential is closer to what's happening now. Valuations across the globe, you can see the US still relatively elevated compared to other companies that are a little above long-term average in some cases, but not nearly as much as the US, and this in particular for large companies. If we look at a number of indexes, including the Magnificent Seven, this index or fund, just for a market example, doesn't have long enough history to go back 5 and 10 years, but we can see here that whereas if we go back for a full 15-year period, large cap growth, which includes in 10 years, that includes those Magnificent Seven, which has really had an extra strong run for quite a while, have by far the strongest returns, but have been a little bit cooling a little bit more recently, not into negative territory, but cooling relative to the catch-up returns or the bounce-back returns of small cap and value and international, as you can see here. This last quarter was a bit of a reversal of that, where growth was back on top, even if that was not all driven by the Mag 7, but by a broader segment of the members of the index, in this case, the Russell 1000, but also the S&P 500. So the Mag 7 have charged forward a little bit less, but still strong for now. We don't usually talk about sector results, but thought we would just point out that some of these numbers we're talking about here in terms of technology, which is a big part of what's inside the Russell 1000 growth, and for that matter, because of the proportional weight of those Mag 7 stocks in the S&P 500, a lot of that is technology-driven, technology companies that had by far the highest return by more than 2x for the quarter at 32% for just one quarter. Then if we look at quality, that sort of excitement and technology and focus and AI drive and momentum trading has led, we'll see two different charts on quality here. This one shows that lower quality stocks have outperformed by the percentage here. So, or conversely, high quality has underperformed low quality by the numbers here, if you consider the negative sign. So it's been a while, even if quality was stronger last quarter on these charts in general. This is a pretty big differential, illustrating some excitement around stocks that might be, again, considered overvalued by many. This chart shows a somewhat different picture because it shows how quality has been on a downtrend for the past 3-4 years, but showing, based on a slightly different measure of quality, a little bit of an uptick. This is the broad US market, whereas this chart here shows large, medium-sized companies and small. Here, this is the broad market all rolled up. Slightly different metrics. This one focuses on return on equity, stable earnings growth, and relatively low debt levels, maybe a bit of a simpler measure than the metrics that are used to define quality for this page. But I think the more important thing to see here is that when there's a steep downtrend for a while after quality, there tends to be a spike. That's usually because there's excitement when low quality is in favor. It's usually because of overexcitement and extended valuations that then there's a bit of a reversal. And so we've been in a period now where that quality had been cooling because of that excitement about more speculative stocks. Now, if that trend picks up, that could be a sign, or if it were just a continuation of a historical pattern of cycles where the markets are overexcited about ideas and then there's some correction or adjustment, and quality tends to do better in those environments. In terms of recession scenarios, no updated projections, still 35%, which is still a third chance, but not high. And at the moment, there's nothing obvious on the horizon, but oftentimes downturns come from unexpected effects and dynamics, and inevitable, whether it's sometime soon. That's just the nature of economic cycles. Employment numbers and wage growth. We can see wage growth continuing to cool. That puts a little pressure on the consumer, while the unemployment rate has been picking up and hovering. So that, again, but also puts consumer pressure and pressure on spending, since about 70% of GDP is the consumer spending effect. And so if consumers become more concerned or more reluctant to spend, that can slow the overall economy. We talked about inflation. You can see here the spike up, really primarily due to oil. And so that may be heavily dependent on what happens in the conflict in the Middle East, and a little bit unpredictable in terms of how that flows through the economy. Fed rates, again, as mentioned, were held steady, but also as mentioned, there is the projection that there might be one Fed rate increase before the end of the year. We look at the bond yield curve. Last quarter, it was slightly inverted at the beginning, and then a more normal shape curve over longer maturities, bond maturity. Here we can see a little bit uneven at the early end, but really a much more normal shape. So overall, the yield curve is normalizing up and to the right. So that if that suggests, from the bond market standpoint, reasonably solid economy. If the yield curve, when there's an inverted, especially when the long end is lower than the short end, that's often a prediction from the bond market of cooling economic dynamics. Consumer sentiment picked up a little bit, but still roughly near 50-year lows. So whether it's because of high prices, that even if inflation has come down, there hasn't been deflation. So the high inflation period has affected people while wage growth has been cooling, and all of that can make people worried about the future. Rules and regulations. Won't go into detail. The 530A accounts, also called Trump accounts. We talked about this a little bit last quarter. Is also a new blog post to look at to see how that might benefit you or someone you know. On the retirement plan side, there's some updates around forfeiture lawsuits. So there's some extra attention there. So it makes sense for clients to pay extra attention to make sure you're treating your forfeiture accounts properly. Auto enrollment has been increasingly common. That is, in our view, auto enrollment and auto escalation really help systematically increase savings rates to help plan participants. Participants can always opt out. We do encourage plan sponsors to adopt both of those provisions to more systematically help people avoid the inertia problem of not saving enough and waking up 10 or 20 or 30 years later wishing they had saved more. Some of the trends that have come out of the increase in auto enrollment and auto escalation are that looking at one slice of data from Vanguard and their very large plan client space, 86% of eligible employees participated in plans, and there was a 12% overall savings rate, 7.5% of which was from the employee, the rest from the employer. So that's a general improvement over time. Average savings rates are going up, and this 12% is roughly in line or not too far off the generally recommended savings level of 10 to 15% or 12 to 15%, depending on age and how much savings has been done, and lifestyle expectations and retirement age projection and so forth. So our client base is roughly similar to some of those numbers, and we're encouraging clients again to auto enroll and auto escalate where they feel that may be helpful and where it fits their philosophy around the 401k or other retirement plan as a benefit. Number of new blog posts, including those 530A accounts mentioned a moment ago. Something for plan participants in particular, when it might be helpful to take a loan from a retirement plan and when you might not want to. Information about the Roth catch-up rule being live. The topic of whether or not we're in an AI investment bubble and how to think about that. And we also have a retirement plan fiduciary video, which we mentioned previously, a good resource for new committee members or existing committee members on retirement plans that want to refresh their memories about fiduciary responsibility. And then we also have separate education videos for plan participants, and we post those on wealthstep.com, the website that we have built for plan participant utilization. With that, I want to thank you for attending today. We appreciate your attendance and your support if you're a client, and please contact us if you have any questions or other ways we can be helpful to you. And as always, if there are clients or other people or organizations you know that we can help like we've helped you, we want to increase our impact, our positive impact on people's financial fitness and financial stability and living the lives they want to live and helping their communities as well. We also have an additional section that we won't go through here. If we're in a client meeting and you'd like to go into other areas, we're happy to do that. Here we'll stop and see if there are any questions.